Hello, everyone. Welcome to this finance roundtable. This is the finance story, of course. We have partnered with Qapita to launch a series called Finance 2022 and Beyond. This series was key in discussing finance trends that will define 2022 and beyond. Let me introduce my guests. Today, I have Lakshman Gupta Kanamarlapudi, who is the co-founder and CEO at Qapita. We have Amit Singal, who's a general partner at Fluid Ventures, and he's also the founder of Startup Buddy Services. And I have with me Shalini Jain, the partner partner people advisory at E&Y India. Hi, Shalini, Amit, Lakshman, how are you guys?
All good. Thanks very much, Vishal.
Hi, Vishal.
You know, the topic, sounds very easy, which is finance in the age of technology, startups, and venture capital. But before we break into that, I want to break the ice by asking what you guys do. I'll start with Shalini. Shalini, what do you do at E&Y?
Hey, Vishal. So at EY, I would say it's my second home. So I spend a lot of time at EY physically, mentally. I've been with this organization for close to 22 years now, part of People Advisory Services, essentially focusing on all tax and regulatory issues around people agenda of an organization.
Brilliant. Amit, tell us a little bit about your company and the venture fund.
Sure. So Vishal, I am a founder of a company called Startup Buddy, where we are working with startup founder like a buddy in the legal and compliance. We are a one-stop solution where we provide all kind of services to them under one roof.
Lakshman, great to have you on board. And we all know Qapita, but it'd be nice for you to tell us what Qapita is doing.
Yes, thanks, Vishal, for having me again. Essentially, Qapita is in the business of equity management. We help startups with their Captable management and ESOP management, and essentially managing the Captable on a system where everyone is saying one single point of truth of the equity ownership of the company.
Amit, you started as a traditional CA, right? And you made your jump into the startup world. Why? I want to know, why is finance as a function changing, firstly? Some thoughts on how startups are getting geared to the changing finance function, especially after COVID hit us all.
Sure. So Vishal, see, startup is nothing but a business, and no business can run in case the finance function is not in fully controlled there. So that is a very important function for any business to run and to understand the various terminology related to investment side as well, like what is your unit economy, what is your contribution margin, what is the CACs look like. For the entire calculation, it is very important that your finance function should be very strong. And we have seen many cases in the past as well, where the startups are not getting funding in the subsequent round because they failed in the due diligence. They are not compliant. And that was not intentional, because lots of startup founders do not know how many compliances are there in India. So in case you want to be a fully compliant company and you want to have a full control on the finance as a CEO of the company, it is very important that the finance function should be very strong. And to get that, you need money, because in case you need 4 or 5 people in the finance team, you will have to teach them that what is your expectation, and lots of energy can go there. So it is always better to go for a virtual CFO services at the initial stage. And through technology, it is very much possible, because now lots of tools are available where the checklists are available, where there can be checklist, and CEO can be fully confident that yes, all the compliances are done. There are various tools where the various ratios or the promoter ratios, entire ratios can be on the tips of them. Even that can come on their WhatsApp as well.
Lakshman, I want to bring you into this. I see a lot of finance people, starting out their careers now, reluctant to join startups, yes, right? Especially technology-related startups. Yes. And if you have to talk about how finance as a function has changed, right? Obviously, being a founder is about risk. Yes. But in your case, your advice would matter to a lot of them who want to join technology companies.
If you're as a finance professional, apart from tech startups, first is I think selecting the sector is the critical. Selecting the right sector at the right timing makes it, because that gives you a lot of tailwinds. For example, if you have to make choices at this stage to join a sector, one need to think about that. What is that big tailwinds? Like B2B e-commerce is a big tailwinds. D2C consumer brands, which earlier it was only with the 4 large conglomerates used to build all the brands. Setting up a brand is not so difficult. And once you create a valuable brand, it's a huge value creation. or for that matter, even a delivery, like end of the day, whether it's a Swiggy or a Zomato or a Flipkart, all of them are moving one thing from one place to another. Anything to move from one place to another is a sector which there'll be tailwind for 10 to 20 years in a country like India and Southeast Asia, where there's a lot of bottlenecks. So and what is enabling this is technology. And so joining this. And then the general trend of asking whether one can join a startup at this stage, if you ask this question 7-8 years back, yes, it's a risk because there's no much ecosystem, and a company becomes a unicorn. Earlier, it used to be 10 to 12 years to become a unicorn. Now, if you're in the right sector, right support, the company becomes unicorn in 5 to 7 years. But there's a lot of opportunity. So if you join a startup, and a person who becomes as a finance professional is choosing a startup, you can become a CFO of a large startup at the age of 30 to 35. Is possible now. Even if the startup fails, that experience is valuable. You move to the next startup and the career is set, sort of thing.
I want to talk employee mobility at this point of time, which is Shalini's subject. These are changing scenarios. Everybody goes to startups, and that means moving jurisdictions overseas. How do you handle somebody handling finance, say across the world? How do you handle a technology guy serving the entire world, Shalini?
Right. Yeah. So Vishal, this is in today's day and age, no role is limited to one particular geography, right? And we have, situations where there is a CEO sitting in one country and overseeing multiple jurisdictions. So this does involve a lot of, regulatory implications, both for the individual per se and also for the organization. Now, let me talk about the individual first. So if supposing there is a finance professional who's not just, managing a country A, but is also like a group CFO managing multiple jurisdictions. Now, for him, where does he get, taxable? So is he taxable in the country where he's sitting? He must be traveling to multiple jurisdictions. So what happens is many a times, individuals are not cognizant of the risk that they are creating for themselves by moving different countries for shorter duration. So each country has their own threshold for triggering tax liability. While India, and let's take an example of an India startup having multi-jurisdictional presence. India will have, tax avoidance or double tax avoidance agreements with most countries, but are these individuals aware of the fact that even if they are spending business, they're going on a business visa and they're spending extended time in those countries, a normal understanding would be, oh, I'm just going for a business meeting, I'm not triggering any tax liability. But it is possible that the laws of that country may require him to pay taxes in that country. So tax becomes an important consideration because of moving different countries, and one needs to be cognizant of that. Second is also from an immigration standpoint, are you going on the right visa? Are you going there executing contracts? Is it the right visa for, so sometimes people may just travel on tourist visa to different countries and actually conduct official work, which is not right. So what happens is there are a lot of moving blocks. So you are not just exposing yourself, you are also exposing your organization to all these risks. So if there is a finance professional of an Indian company who's also signing contracts sitting in another country, then there is a risk, what we call as a permanent establishment risk for the Indian company in those countries. So so there is a personal tax risk, there is an immigration risk, there is a risk of creating permanent establishment. Then there is a reputational risk for the organization. If you're not complying with the laws of that country where you're going and sitting for some time, or you're working remotely. So I think it's all very complex, Vishal. So my suggestion or my advice to, and it may be finance professionals themselves, it could be teams below them, it could be other business associates within the organization. I think one has to be mindful that employee mobility is complex, and one needs to be mindful of all the impacting regulations, because you won't want to be caught on the wrong side of law. It could be a huge reputational risk. I think I always tell my clients that, while, you can get away with by paying penalties, additional taxes, etc., but the reputation is at stake. So you can't be seen as not complying with laws of land in a particular country.
And Lakshman, coming back to you're automating your profession, ESOP management, transactions, you're ensuring that Captables are managed. Of course, I mentioned earlier, equity management. And when you offer such a role, what is the role of a finance professional? So with technology growing, would the finance function be the same 10 years from now?
I think, Vishal, I think it's not, actually what companies like Qapita, what we are doing with ESOP management or Captable or other fintech companies are essentially are productivity tools basically. So they're actually reducing saving the time of the CFO or the finance professional and enabling them to focus on what is the core business function and the deliverable rather than doing unproductive work. For example, if it's a Captable is managed on an Excel sheet, then the person is spending a lot of time. If different person is asking for different formats of the Excel sheet of the same cap table and different cuts of the same cap table, and then people have a different point of versions of the cap table. So the finance person and the team is doing reconciliations of the various Excel sheets. Whereas by putting it on our Qapita system, you would just click a button, you get the cap table, whichever the version. This is not disrupting, but actually saving the time of the CEO. I don't think any finance professional really enjoys reconciling various Excel sheets and trying to version 1 to version 3 to, and which one did I share to the lead investor, which one did I share to the angel investor, and reconciling between various formats. So essentially the role of the CFO eventually would become, even now or even going forward, apart from things which Amit mentioned in the beginning of various role of a finance professional in terms of due diligence or funding or those, but choosing the right business tools. Now, like what we call is a CFO stack, right? The CFO stack consists of right from the ERP management to receivable management, payable management, compliance management, FP&A, equity management, and there are other CRM and other applications. The expertise of the CFO, the person will be very valuable if the person knows which applications to choose at the right stage of the company and when is the right time to migrate from one application to the another application, so that you are managing the resources at the entire CFO stack, and whoever has manages that and who's on the top of those CFO stack applications is very valuable for any organization, because essentially what is startup? It's experimenting and scaling very fast. Whoever can bring the right application and saves the time and gives the productivity immediately will be very valuable. Whether it's now and in 10 years, that would be one of the critical function of the CFO is choosing the right applications and being on top of the applications.
Okay. Amit, you work with so many of these startups. Are they aware of these changes that are happening in terms of automating the finance function, of course, but making the finance function more relevant? So how do you help these guys understand that, look, you can automate some processes, get a strategic CFO, but do you see that happening at all, or do you see founders taking that burden and playing the role of a CFO?
No. These days I have seen lots of changes in the founder as well. They are really giving an importance to the numbers. Earlier that was not the case, but definitely they are giving number. Means they understand that without number they will not be able to succeed. So that's how technology, and I totally echo what Lakshman said, that technology is not something which is reducing the work for the professional, but these tools are giving real-time numbers to the CFOs or the CEOs on the tips of their phone. So that's how they are helping. But definitely people have understood that without number they can't go in future. So they are giving due importance to the tool as well. And even sometimes there are tools which takes more time than manual. But still, we advise to the startup that you should use the tool for the control perspective as well, because in Excel, a single formula change can change the entire answers. So that is not the right strategy. And because of tools, everyone can have a same information at the same time through cloud. So that's how people are understanding them. And because these founders are from tech background, they understand the importance of technology. So most of the startups are adopting the technology as a tool in the finance professional as well. And that change I'm able to see clearly over the last 5 years.
Has it been an impactful change? Have you seen them redefining how businesses are scaled?
Yes, absolutely, because that change are bringing lots of controls under their different divisions as well, and they can delegate or can control their multiple functions as well. Because through technology, you can go as deeper as possible. That is not possible in the traditional accounting work, where the entire thing was made only for the statutory purposes, not for the MIS purposes. But now the MIS can be at any level, at the cap table can be any level. Employees may be very happy once they be able to see that what is the current valuation of my ESOP. Otherwise, that is very common question as a chartered accountant to me as well, that what will be the tax rate, what will be the final outcome in my hand, What if I will have to subscribe those shares? So those questions are now not there in their mind. On the click of the button, they can see that how much percentage I am owning. What if I will grant option, convert the option into shares? How much tax I will have to pay to the government? Whether my tax will be long term or short term? How much taxes I will have to pay? What is the final outcome in my hand? So in case employees are happy, company will do well. On the same way, investors are aware that in case I need an IRR of 10% on my investment or 25%, what is the potential valuation on which I should do an exit? So these permutations and combinations are only possible through these tools.
A CFO has to deal with ESOPs, role of ESOPs, equity incentives, Shalini. So for you, when you look at this role of ESOP, what do you see it as a vehicle to attract and retain talent? I think it's important to automate this. Amit made this very good point, right? Your thoughts on the same?
Yeah, so I think I agree, Vishal, and I've been doing ESOP for a living for almost 15 years, and I've seen how organizations are dealing with it now, right? So earlier, when we used to approach a client and the client used to engage us, our role used to end by, after we had designed the scheme, help them with the documentation, employee communication. But now, yes, they want somebody to come and automate the whole process for them. Employees have become more informed. If that is the level of understanding, that it is not just at the time of negotiation, an employee would want to see at any given point in time, if I have been granted equity, what is the value of that equity to me today? He wants to make decisions, post vesting, whether to exercise, not to exercise. What is my tax impact going to be? What is the valuation of the company? What is the liquidity event? Now, if all of this is automated, it becomes very easier, both from an employee standpoint and also from a founder and finance professional standpoint. So having an automated, tool where employees have access, the payroll function of an organization has access, I think it works very well.
Okay, I want to stick with you, Shalini, and talk about your experience with startups in general. What are some of the pain points in terms of, one is we've spoken extensively about employees, automating ESOP management perhaps, or even Captable management being ready to be funded or whatever. Your experience generally with founders, are they really well informed? And
yeah, so Vishal, very valid question. So most of the founders, while when they're hiring people, they make these soft commitments. We are going to give you an X percentage, or if your CTC is 50 lakhs, 20 lakhs will be given as ESOPs, and they forget about it. Only when the employees come knocking that it's been a year, 2 years, they realize that they need to put the plan into action. And then what happens is that when they decide to do a proper scheme in place, there are certain requirements, and I'll give you a case in point. So both for and it is equally applicable to startups. For unlisted companies, you cannot give pre-vested options, so there has to be a minimum period of 1 year between grant of vesting. Now, most of these founders, when they have made promises to these employees 2 years back, and if they now institute a plan today, they can't give pre-vested options, and employees are disgruntled because employees are saying, we've already spent 2 years. Now you're saying you're going to make a grant to us today, and we still have to wait for a year before these options vest. So some of these, issues. So that's one, which is very classic. So my, advice to the founders is that if you have decided to do ESOPs early on in your journey as a founder, I think it is better to put a structure to that promise. And the sooner you do it, the better it is for you, even before your funding starts coming in, because even at a later point in time, when you have VC investors coming in, they want to see the cap table. They want an ESOP pool already created. They want some ESOPs to be already been issued so that they don't get diluted because of the ESOPs. So I think that's where some of the learnings for founders are: honor the commitment early on, keep in mind the regulations, and make sure that you put the structure in place before it gets too late.
Okay, and the labor law is changing. Are they going to add any value at all? It's going to be simplified, of course, but is it going to be regulated even more work for founders? And obviously, Lakshman can automate that too if he wants to. Yeah. But where do you see that going, Shalini?
So, very hot topic, Vishal. So and maybe I'll spend a minute to just give you a little bit of what's happening. So our labor laws are archaic. We are living with almost a decade old, century old labor law.
A century old labor laws.
Yeah, the central government is, in the process of coming up with these labor codes and likely to be effective this year. And 29 existing central labor laws are going to get compressed in these 4 labor codes. Now, there is a complete overhauling of this. There are a lot of changes. So both from a cost perspective, from an organization, from a compliance perspective, the way the people are hired, the way people are compensated, a lot is going to change. So it is not just it is definitely the founder or CEO's problem. It is also as much of problem of the finance function in an organization. One of the biggest change which the labor law is going to bring is how the change in the definition of wages on which most of the employment benefits are calculated. And these benefits are typically provident fund, gratuity, leave encashment. Now, most organizations today are used to calculating all these benefits on a particular base. Now that I'm not going into technical details, but that base is increasing. So the moment that base increases and the company has to shell out more money towards provident fund, gratuity, leave encashment, overtime, the cost of an organization towards all these benefits is going to increase. So from a finance function, there is an impact on the P&L. There is going to be an impact on the budgeting. How do you, and some of these costs are going to be one-time costs. Some of these costs are going to be recurring costs. The actuarial valuations for gratuity, etc., are going to change. So it is game changing. So some of the startups, something like a provident fund may not be applicable. Some of these laws for an early on startup may not be applicable currently because, they don't have enough number of people. So like provident fund, only if you have 20 or more employees gets kicked in. But as the startups grow, I think what they need to keep in mind is that compliance with labor laws is kind of non-negotiable. And once these new labor codes come in, then they need to watch out for those labor codes and ensure that all their internal compliances, costs, budgets are accordingly drawn up.
Lakshman, your thoughts on the startup ecosystem being nascent. We all talk automation, but again, automation and readiness are two different things. Right. But I wanted your thoughts. How ready are they? What are your thoughts on founders? Promises apart, how are they going to go implement employee benefit programs?
So on this equity compensation as a part of the total compensation, right, has evolved a lot in the last 5 to 7 years. It has evolved very much in the US for the last 20 to 30 years, in China over the last 15 years. But as the startup ecosystem has progressed and has unicorns and almost becoming $1 trillion private companies, and earlier people did not value ESOPs. They treat it as a piece of paper because there's no examples of people making money on the ESOPs. But once, whether it's US or in China, now in India, only once they see real examples of people making money on ESOPs and moving from one orbit of wealth to the next orbit of wealth, two people join the different companies who are of same qualification at same level of experience. One person has moved to the next orbit of wealth and became a millionaire just because the person worked for a startup and there was granted options and that options created wealth. Then that example start making a big change and employees start asking for the equity. Earlier, ESOPs are only for some senior level people at the C-level, COO, CFO, or the people who are bringing sales and stuff for the top 3%, 5% of the thing, and ESOP for the first top 10 people in the organization. But now with ESOP is now being the progressive the startups. Now why a startup even with 3 to 4 employees is adopting Qapita? Because they want to, even when they start the first hires of 3-4 employees, they are granting the ESOPs for the 2-3 employees to start with itself. And so it has changed quite a lot in terms of granting of the equity. Second is that in terms of the ESOP policies itself has evolved quite a lot. In terms of earlier, the ESOP pools used to be 5%, but now founders are being liberal and trying to say that we need to create larger pools. Even at the early stage, they're creating a 10% and a 15%. Some progressive companies are creating a 25% pool because if the employees are creating wealth, they are working hard. Even if people have smaller person as a founders have small equity, but it's part of a larger value rather than having big equity percentage in a small value company. Then even the companies are granting much more like earlier because it's need to be managed on Excel sheets and all. They are saying I'll give yearly vesting. So if I leave in the middle of the year, I lose the ESOPs if I leave in October, I lose for the entire year what the value I created. With applications, people are adopting the tech. Now you can have yearly vesting, quarterly vesting, monthly vesting, and couple of companies in India are saying daily vesting. So that every day you are gaining some value in the ESOP, and people can see that some value is being credited to my equity every day going forward. And then people are also adopting progressive policies in terms of also the exercise. Like earlier, right? People used to be a little bit like nasty, saying that if you leave the company, your ESOPs need to be exercised within 10 days, and you need to pay this much tax, and I'll borrow money to pay the tax without knowing whether I will eventually get an exit, sort of a thing. But people are being progressive and saying that, okay, this is what you earned. Some companies are giving almost 10 years to exercise, or some people are saying indefinite exercise period. You gain this. So this is a lot of progressiveness is coming in terms of the implementation, size of the pool, and policies, and distributing the equity to all the employees as possible.
Advise early stage startups. You're also helping growth stage startups. How do you advise a founder to evolve with compliance and regulation? It's very difficult to let go of equity, either for senior management, of course, now it's table stakes, but now also for employees, what advice do you give them, and what have you noticed?
Yes, absolutely. As you mentioned, that because of Shark Tank on lots of initiative by the government in India, now everyone's understand that what is startup. It is not like that doing a business and making sure that every month you are getting the right kind of net profit for the stakeholder. It is more than that, and creating a brand with a valuation game. So people are working on them and they are not only creating wealth for themselves, but creating wealth for everyone. Means in the previous question, we have already seen that now the trend is changing, where everyone means founder every employee want to become partner of that company. They don't only want salary, but they want to become partner in the progress as well. And they want to see their companies to reach at a stage where the IPO happens and they get a good exit with lower tax rate, because all of us know that in listed securities, the tax rates are little lesser, and in unlisted companies, the tax rates are little higher in India. So everyone who want to join startup, they wish that the IPO comes sooner. So that is the wish by everyone, and that wish you can create in your employees only by giving ESOP. Otherwise, they will be only concerned about their salary. So definitely this trend changing is definitely helping the entire economy. So that's how we can see the entire change. And definitely in wealth creation, the founder needs lots of hand-holding. They need lots of advisor. They need employees to work like a family member of the company rather than thinking that they are an employee. So they will have to work in such a situation where all the people work together for a common goal, which should be wealth creation for the company, for everyone. And definitely for that, technology may play a very significant role. And without having proper finance control in place, or the technology, or the other measurement, that is not possible. So definitely lots of things finance professional will also have to change in their life, rather than thinking that they are meant only for the compliances or the financials. They will have to think like a person who is becoming a partner and giving right advice to the founder as well in various terms.
Okay. Shalini, I mean, a lot of it has to do with policy also. A lot of the founders say that, the ESOP pools are not well structured because of the government policy. But your real thoughts on changes, right? Changes when the labor code changes, right? When the labor laws come down to these 4 simple codes, right? Then there is more responsibility for the founder and the CFO themselves.
Yeah. So very valid point, Vishal. In fact, I would tend to differ with founders here, and I'll give you a couple of examples. Now, ESOP regulations have evolved in India. Earlier, till Companies Act got amended in 2013, we did not really have any regulations for unlisted companies, and unlisted companies could pretty much do whatever they wanted to do. And there was a lot of misuse also. A lot of founders, gave ESOPs to themselves to increase their equity holding, etc. And then these regulations come, which gave kind of a structure to this whole madness. In case of listed companies may not be relevant, but I just to understand the government mindset. Now, for listed companies, there are these SEBI regulations which are applicable for ESOPs, and they are also undergoing change. We had guidelines of 1999, then we had one set of regulations came in 2014, then the recent ones changed in 2021. Now, and I'm explaining you the change in government mindset. The government has become, in fact, more pro-employee when they have changed these regulations. Two examples. Now, earlier, the definition of employee was very restrictive. You could not cover, if there was a organization which had holding, subsidiary company, associate companies, they could only cover employees of holding or subsidiary company. They could not cover employees of associate companies. Now, for listed companies, the government has extended that benefit, which means that you can cover many more employees, even if you have, say, and you have to fall within that definition, which is typically joint ventures, etc.
Okay, we lost her there.
You can cover those employees. Second, your example, your example of the company in the valley where employees could even get benefits much after they had left the organization. So our SEBI regulations also, the latest amendment now says that earlier, if you resigned or if you left the organization or you retired, whatever was unvested would lapse. Now, one of the beneficial provision which has come in and this is right now restricted to listed companies, is that if you are leaving the organization on account of retirement and you got some grants, those vesting will continue even later on. Which just shows the mindset of the government. They are becoming, so it's not as if they are restrictive or they are not pro-employee. Now, if a scheme is not well drafted, it would be, just a poor vision of the founder rather than blaming on the regulation. From the government standpoint, at least on the ESOP space, I would say we've seen much more progression. We've seen the government, coming up with multiple papers, inviting public comments, and I'm sure whatever changes have happened for listed companies would very soon be incorporated for private companies as well. Labor laws, yes, coming to your other point on labor laws, again, it's a game changer. It's something what GST did to us is what it is going to do to the industry. So a lot of it is still to be seen because we are still awaiting the state level rules there. But again, the mindset is simplification of the labor law compliances in a lot many ways. Ensuring that there is ease of doing business in India for MNCs who come and set up shops in India. Yes, it has certain set of complications as well, but I'm sure GST also did not come up with all the answers to everybody's problem at one go.
Absolutely.
I'm sure with labor laws also, over a period of time as they evolve, from the compliances would definitely become easier, and there may be some additional costs, but I think there may be, the organization would see it as one-time hit, and then that becomes the basis, and then you kind of accept that it is the cost of doing business. So, but I think from an overall perspective, the founders need to be mindful of all the regulatory changes. And they need to ensure that they factor in all the additional costs at the appropriate time. Just one more point, maybe very relevant, and if our audience is a finance professional, is that even ESOP schemes come with a accounting hit to the P&L. So I think sometimes, that factor is missed by, so a lot of founders may not understand. If they don't have a dedicated CFO to guide them, they may not know that every time they roll out a scheme, they are going to be taking a hit to the P&L. So that's something that, founders need to be mindful of, that there is a charge which comes to the profit and loss account over the vesting period. And there are guidance from the Institute of Chartered Accountants for companies to whom the Indian accounting standards are not applicable. And once Indian accounting standards become applicable, we have a specific accounting standard to deal with how to take the charge on account of ESOP expense to the P&L.
The role of technology now, everybody talks blockchain and auditing. There can be a P&L charge if you have an ESOP, right? In the long run, investing. And if there's a blockchain, there's an audit trail also.
Yes.
For example. So do you see that happening at all?
Right. I think there's a lot of tech implementation to be done, or a lot of tech progress will happen in this compliance aspects. There's a long way to go in India because there are a lot of compliances to happen apart from the compliances about ESOP or this thing about filing of the registrar of the thing, shareholdings, or GST compliance. There are quite a few companies doing a great job in compliances of that, but there's still a long way in bringing automation because there are multitude of compliances to do. And coming to the Web3 or a blockchain, so I think that is a huge, humongous opportunity. There's a lot of pillars for the Web3 or a blockchain because it's based on cryptocurrencies, distribution ledger, and a common currencies. There are various things and one can discuss in detail, but what this ultimately will bring through is a distributed ledger where there is not one central authority managing it, and it's distributed responsibilities and complete transparency and complete audit trail. Even as the core of it, that's what this blockchain is bringing up. Even though there's a lot of noise about cryptocurrencies value going up and down, that will be the noise, but there's a lot of investment and a lot of innovation happening in this technology. In next 3 to 4 years, there'll be a breakthrough in these technologies, which will make this entire transparent and make it much more easier and much more auditable, as you rightly mentioned. Yeah.
And Amit, over to you. In terms of the role of technology today, what is the reality that you see happening in terms of AI, blockchain? What are the low-hanging fruits? What should founders embrace and not embrace?
Yeah, definitely. But from the perspective of a finance, I don't think that lots of high-tech technologies are required as of now. We will have to take one step at a moment. Okay. So I normally bifurcate the technology for the finance professional into 4 parts. First one is revenue recognition, where any technology will work where you are not doing any revenue losses. So entire O2C cycle should be covered under that, which will start from order to cash collection, and no step should be missing there. So it can be through AI, it can be simple technology, but take an example. In case you are using manual, you are chasing your debtors manually, then it means you are not using technology at all. Even 1 decade ago, we were using mail merge, and there are technology where on the one click you can send emails to all your debtors that what is outstanding, and in case there is any delta, they can online update that. As per my understanding, I have to pay less, and this is the delta because on account of GST or TDS, or I paid something, you are not there. So the technology should be used for the communication part as well, and for the sending reminders or sending invoices as well. So that is the first part which I always ask my finance professional to take care of that. Second one is payment side, where there are lots of technology in the market by only updating by the invoices, the payment can be done, and all the TDS compliances can be done, or all type of compliances that softwares take care of that. So you need not to be worried whether the TDS will be deducted at the rate of 2% or 10%. Just upload your invoice. Either it will read all the contents through scan, or you will have to update certain cell, and it will automatically do the payment to the vendor as well, and it will file your TDS return. Those kind of softwares are required. Third important part is payroll, because lots of compliances are applicable on payroll. Shalini mentioned in detail, and apart from central, every state has a different kind of compliances applicable. In Haryana, labor welfare fund is applicable. On Bangalore, professional tax is applicable. So again, in case you have an employee in 32 states, it means you will have to file 32 different kind of returns as well, which can be taken care by the technology part. And again, the employees will be more happy if they will get their tax calculations, salary slips, everything on time through technology itself on the go, rather than every time they have to write an email to HR that I want to get my tax calculation, when someone will email manually. So entire payroll should be automated in an organization. Then last part is compliance, where there should be checklist, and there should be one sign off every month that all the compliances of the companies are done, all the taxes have been paid, all the returns have been filed. And then cash flow statement is specifically important for the startup, because the startup founder do not work on the P&L basis. They always treat the cash flow as a main thing, because they raise the funding from the investor, and they always believe that every time their runway is very less as compared to the other corporates. So every time they have to calculate that how much runway is left. So it does not means that in case you have taken the GST input credit in your balance sheet, that is not an expenditure for a startup founder. From startup founder perspective, whatever cash is received, that is income for me, and whatever cash has gone, that is an expenditure. That is the typical definition for the every founder. So that's how cash flow is a very important thing, and there should be certain dashboard which reflect the cash flow statement of an organization, and the important ratios, that what is your customer acquisition cost, what is your other ratios which are very important for any startup founder to think whether he want to go into that directions or not. So in case those 4-5 things are available, then technology are playing very important role. sorry, because I do not know about much technology, that which technology should be used. That should be the end result of any technology.
Right.
Yes.
So the final segment is quick 20-30-second answers from each of you on the future of finance and the startup world. Okay. So Shalini, I want to ask you, what should the founder focus on over the next 18 months to 2 years?
I think other than focusing on the core business, important not to lose sight of the compliance and regulation and employee retention. I think these are two key. You can't do anything without your good talent team. And also, you can't be on the wrong side of law.
Amit, your advice to them quickly.
Definitely make sure that you have a right team. Do not lose any key employees. Make sure that they are retained. Apart from it, make sure that every process is in the finance is at the right place. Do not do any non-compliance at all, because in future lots of big VC funds are only focusing on good corporate governance in the company before putting the money, rather than thinking that what can be the growth potential of that company. Corporate governance is going to be very important thing for any VC in the future.
Great. Lakshman, your thoughts?
Last 18 months, 2 years, I think the core is the cash. Keep have a heavy control on the cash and keep the cash flow at least for the next 18 months to 2 years runway. And second, use as much tech tools as possible to reduce your cost and increase your productivity, and increase them and distribute your equity to as many employees as possible. And you can reduce your cash, and also you have better engaged employees through equity.
So thank you very much, ladies and gentlemen. Thank you, Amit. Thank you, Shalini. Thank you, Lakshman.